The average Canadian mortgage is systematically designed to keep you poor. You go to work, you pay a massive amount of income tax to the government, and then you are forced to use your remaining, severely depleted after-tax dollars to pay the interest on your home loan. But what if you could legally flip the script and transform your primary residence into a massive tax-generating wealth machine? Welcome to the 2026 Guide to the Smith Maneuver. As the cost of living continues to punish the middle class, wealthy Canadians are aggressively utilizing a perfectly legal, heavily documented financial strategy called the Smith Maneuver to entirely eliminate their non-deductible mortgage debt while simultaneously building a massive, dividend-paying investment portfolio. If you own a home and have at least 20% equity built up, you absolutely need to understand exactly how this mathematical strategy functions. The fundamental premise relies on a core rule in the Canadian tax code. Interest paid on money borrowed for personal use, like buying a house to live in or going on a vacation, is not tax deductible. However, interest paid on money borrowed for the explicit purpose of generating investment income is completely 100% tax deductible against your marginal income tax rate. The Smith Maneuver is simply the systematic process of converting your bad, non-deductible mortgage debt into good, tax-deductible investment debt. To execute this strategy, the very first thing you need is a specific financial product from your bank called a readvanceable mortgage. This product seamlessly links a traditional amortizing mortgage with a home equity line of credit. The magic happens in the mechanics of the payment. Every single time you make your standard monthly mortgage payment, a portion of that payment goes toward paying down the principal balance of your home loan. In a readvanceable mortgage, every single dollar of principal that you pay off is instantaneously and automatically made available to you as new borrowing room inside the attached home equity line of credit. Step 2 is the deployment of capital. Instead of leaving that newly created borrowing room sitting empty, you immediately draw that money out of the line of credit and invest it into an income-producing asset. In 2026, the most common vehicle for this is a portfolio of Canadian dividend-paying stocks or broad market index funds held in a non-registered taxable investment account. Because you borrowed this specific money to invest with the expectation of earning dividend income, the interest the bank charges you on that line of credit is now entirely tax deductible. Over the course of a 12-month calendar year, you simply repeat this process. You make your mortgage payment, the principal drops, the line of credit limit increases, you borrow the exact difference, and you buy more investments. Your total overall debt level does not increase by a single penny. You are merely shifting the debt from the bad side of the ledger to the good side of the ledger. Step 3 is the accelerator, and this is where the strategy creates explosive wealth. When tax season arrives in the spring, you take all of the interest you paid on the line of credit and deduct it from your total taxable income. For a Canadian in a high marginal tax bracket, this deduction will trigger a massive, highly lucrative income tax refund from the Canada Revenue Agency. Most people take their tax refund and buy a new television or go on a trip. The Smith Maneuver requires absolute discipline. You must take every single dollar of that tax refund and apply it directly as a lump sum prepayment against the principal balance of your traditional mortgage. This massive lump sum payment instantly drops your mortgage principal down even further, which immediately opens up a massive chunk of new borrowing room in your line of credit, which you immediately borrow out to buy even more investments, creating an even larger tax deduction for the following year. It is a compounding loop of financial velocity. Over a period of 15 to 20 years, your expensive, non-deductible mortgage plummets to absolute zero, far faster than a standard 25-year amortization schedule. Meanwhile, you have quietly built an investment portfolio worth hundreds of thousands of dollars that is paying you passive dividend income every single month. I must issue a very clear warning. The Smith maneuver is not for amateurs. It involves leverage, and if the stock market crashes, you still owe the money on the line of credit. You must have secure employment, a long-term investment horizon, and strict emotional discipline. If you want to see the exact mathematical blueprint of how this strategy would perform based on your current home equity, your specific mortgage rate, and your personal income tax bracket, visit www.northcalc.com and use our advanced mortgage and tax calculators to map out your strategy safely. Stop paying your mortgage with after-tax dollars. If you found this tax strategy eye-opening, make sure you watch my previous video where we break down why the real estate market in Saskatchewan is vastly outperforming the rest of the country.